Good to see everyone. All right, awesome. Sorry for the delay. We had a little bit of technical difficulties getting on. I see some familiar faces. Hey, Zach, what's going on? And so today I just want to kind of, first of all, this is the second time we're doing this webinar this month. We had a really awesome turnout for the last time. Hey, Zach, what's up? Last time, and we're going to be kind of doing a bit of a pivot based off some feedback that we got, which I'm super excited about. But before we start, why doesn't everyone kind of just leave a comment in the chat here? Let us know where you guys are located. See where we all are together in this virtual room. Who wants to go first? Anybody? Nobody? Everyone's shy. All right, cool. Well, let's go. If you guys do want to, oh, there we go. Finally, Austin, Texas. Hey, what's up? Awesome. So everyone else who wants to go in, feel free to share where you're at so we can kind of all make this a little bit of a community in this meeting room here. So welcome to today's training webinar. And there's three things we're going to be talking about here today. Basically, we're going to be talking about tokenization of real estate, and specifically some of the details. Hey, Tia, what's up? Sarasota, Florida. Awesome. I've been in Sarasota, Florida once, a long time ago. I was probably I was a teenager and I went there. Oh, another one in Florida. Tia and Eric, what's up? So here's what we're going to be discussing in today's webinar, right? So we're going to be covering kind of three main topics here, right? So we're understanding how blockchain is going to be changing everything, right? Blockchain is a kind of buzzword, and I know right now in the news today, everybody is hating on it because everything collapsed. And we're actually going to be talking about a bit why this actually is not relevant at all in terms of the crypto and the digital asset space. On the crypto side, actually does not impact what we're doing on the tokenization and security side, and using blockchain as a tool to be able to better our businesses and make things and better our asset management, and allow us to be able to use this kind of really amazing, powerful technology to be able to basically just make everything better. I'm also going to talk a bit about how to understand the mindset of technological changes, because one of the things that happens when things change on a technology level, it requires a different way of thinking about things. And the way we think about things, obviously, is being able to see kind of what's going to happen in the future and be able to take the steps needed now to be able to prepare ourselves for the changes that are going to be coming. And we'll go into some specific details and ways of understanding this. And then we're going to be covering the third thing is we're going to get into the nitty-gritty details of how tokenizations and smart contracts work, and why they make tokenized assets cheaper to manage than traditional securities. We're going to get into some of the details of that, basically showing how when you tokenize assets, it gives you a lot more optionality and flexibility with those assets in ways you never have in kind of traditional sense. And it allows you to be able to also lower costs of the overall management of the asset. We'll get into some of those details later on. So welcome, my name is Gavi. I'm head of marketing at SolidBlock. SolidBlock, we are one of the leaders in the tokenization space. We were actually the first company to tokenize a commercial real estate property, the Aspen, or the St. Regis Resort in Aspen, Colorado. We were also the people who pioneered the methodology that's now the standard in the industry for tokenization. Everyone uses the same process to make sure that that it is done not just on the technology side, but also on the compliance and the regulatory side as well. So let's dive into this. How blockchain is changing everything. So something to understand about blockchain is that blockchain is basically a new technology. It's basically the next version of the internet. And I just want to think back, if anyone who's back in the 90s, kind of the pre-internet days, in terms of understanding how businesses used to run and then how the internet changed everything we do today. Imagine a day where we didn't do something like this, where we're on a webinar, where we're in a room on Zoom with other people, literally from all over the world, all over the country. And no email, right? No digital files, right? The internet changed everything for us, but it took a long time for the internet to basically get to a point where it achieved, I would say, not just mass adoption, but it evolved enough to be able to allow for people to be able to use it for business, right? And this is something that happened throughout the 90s. Initially started with just kind of email. That was initially what it was used for, starting both in the government. And then before it started to become mainstream in the 90s, and they had a lot of kind of attempts, if anyone remembers all of AOL CDs that they would receive in the mail to be able to get them online. That is, that was kind of the early attempts. Of course, we can see that AOL is no longer around, but the fundamental technology of the internet obviously is e-commerce, Amazon, stuff like that. And I'm actually going to talk a little bit about Amazon in a minute. So I want to show you something real quick, and I'm going to do an experiment because this is the first time I have shared a slide deck on this call. I'm assuming it's exactly the same way that you would share it on a regular Zoom call. All right, awesome. So this is the innovator's adoption curve, right? So this is basically when there's a new technology, and as the technology matures and as it continues to be adopted, there's different segments of the market that will adopt. So you're always going to have, when you have a new technology, you're going to have the innovators. You're on the innovator segment of the market that, just like anything that's new, they want to try it, they want to do it. They're usually more techie, they can understand the technical details of something to be able to see how it can be integrated into their life. But they're a very small segment of the market, but they'll usually prove use cases, and that then leads the adoption moving to the early adopters phase, where things become a bit more mainstream, but it's not quite the point where it's at a critical mass. And this is really where kind of blockchain adoption is right now. We're really at the probably even like the middle, later end of the early adopters phase, because once it hits the early majority phase, this is adoption. Right? This is now the adoption, and now the question isn't, are you using this? The question is more, why are you not using this yet? Right? And it takes a while for it to kind of be able to kind of really penetrate the overall market. But that's kind of generally how technology and innovation are adopted in markets overall. So again, what's happening in the blockchain space is very, very similar to what's happening in the internet space overall. And again, kind of giving you a quick example of this is again, we mentioned Amazon before, right? So I'm sure all of us have heard of a company called Amazon. Question is, how many of us have heard of a company called pets.com? Now, if you were in maybe the .com industry, you might be aware of this company, but there's a really important principle to understand. This is actually going to be, if you don't listen to anything else on this webinar, listen to this one point, because this is going to be really important. The underlying business principles are more important than technology, right? Why? And I'll give you an example of this. So most of us have heard, I'm sure, have probably even bought something in the past week from Amazon.com. In the late 90s, Amazon, if anyone remembers, was just a small bookstore on the internet, right? Their value proposition was they were a bookstore on the internet, and we'll get you any book you want at a pretty good price, shipped to you pretty quickly. That was basically their core value proposition. There was another company, it was called pets.com, right? Got tens of millions of dollars in VC funding, also to become an e-commerce giant on the internet, right? And pets.com is gone today, right? And the reason why they're gone today has to do with what was the driving message that Jeff Bezos had when he was founding Amazon and growing Amazon. And he said this, that people ask me, what do I see changing in the next 10 years? Right? What's going to change in the next 10 years? Right? And people would ask him, he would say, I have no idea. I have no idea what's going to change in the next 10 years, but I'll tell you what's not going to change. I don't see a time where someone's going to come to me and say, hey, Jeff, I love Amazon. It's great, but I wish that your products were shipped to me a little bit slower and your prices were a little bit more expensive and your quality and your shipping was horrible, right? It's like, that's never going to happen. So if that's what is driving his principles, it's always going to be moving his company in a direction that's going to make things better. What was pets.com value proposition, right? Oh, we're a pet store online, okay? And we're going to ship you the same pet products that you have in the store, in your pet store up the street, but it's going to take 2 weeks to get there, and it's going to be double the price. So again, it has nothing to do with technology. It has to do with what's the core business principle and foundation that rests underneath this, that's driving everything. And then the technology is a tool to be able to get there so much faster, stronger, cheaper, etc. And let's understand where we're at. Again, we are in the early days of blockchain, but just in terms of some data here, the World Economic Forum says that in the next 5 years, by 2027, 10% of the global GDP is going to be on the blockchain. So 5 years is not a long time, and it's going to happen very, very quickly. And specifically for the tokenization space, more globals expecting that the tokenization economy is going to grow 2.3 billion last year to 1.4 trillion in the same time period. Next 5 years, 2027. So it's something that's like a 5,000% increase from where it is today. It's going to grow very, very well. Now the question is, all of us kind of on the call today to think about, like, what we're going to be doing, where we're going to be doing with our own assets, with our own businesses, etc. There's a great story which I want to think is like how to think about what we're gonna do in the future. So Sam Walton, the founder of Walmart, if anyone has ever read his book, I highly recommend it. Actually, a great business book to understand to understand business in general. But one of the things that he would do, he was in the days, like the early days of retail, the retail market, retail like superstores and stuff like that, and everyone was it was cutthroat like crazy. And what he would do, and he kind of started to kind of really carve away his niche because he found ways to get cheaper get supplies for cheaper, and be able to then sell cheaper. That was how he was able to kind of undercut his competition on the first level. The next thing he would do is he would do the following: is he would generally look instead of trying to find like where's the shopping center where I can put my store. Every Sunday he would go up in an airplane. He had a pilot's license. He would fly around the city, and he would see where the developments that are being built that are going to be completed in the next 2 years. Right? Yeah, exactly. Yeah, at age 44, exactly. Right. He's going to see where's the next settlement, the next suburb going to be built. That's going to be done in the next 2-3 years. That's where we're going to buy land today, and we're going to start building the Walmart now. So when everyone started moving in 2-3 years later, his store was there, and all the other stores now had to compete with him and pay him for space for their stores. And this is how he was able to win. So how can we start thinking about this, kind of in the future, but also understanding not to resist technology. So a great story about kind of resisting technology is with Kodak. So Kodak, right? Kodak, the camera company, today went bankrupt about 10, 11, 12 years ago. They were bought up by another company, right? They were the giants in camera technology, or I say the camera market. And they were completely blindsided by digital camera technology when that kind of really started to take off in the 2000s. By 2011, they were bankrupt, right? They had 80% market share of the entire camera industry at one point, and they were completely wiped out. Why? Now, here's the interesting part. They were sideswiped by this technology, but the thing is that they were the ones that actually invented the technology. There was an R&D guy on their team in 1975 named Steven Sasson. Stephen was a guy who invented digital technology camera in the R&D department in Kodak. And the decision at the time was, we're not going to commercialize this because our film business is doing great. If we commercialize this, we're going to wind up cannibalizing part of our existing business, right? The stock will go down, profits will go down, maybe for the short period before we start to take off again. So, we can't afford to do that. So they patented the technology, they locked it away for 20 years. And then in the late 90s, the patent expired. Someone else took it, they commercialized it, the rest is history. So they wound up ignoring and kind of trying to stifle technology, again, they themselves had actually invented, and it wound up being the cause of their downfall. So it's kind of really an important balance to understand when there's technology that's maturing in a market and it's kind of moving on, but you want to make sure you're not going to wind up being too early. And I'm actually going to show tokenization and blockchain adoption, particularly in the asset space, is actually it's almost risk-free. I'm not talking about some of the details about that later on, but kind of really important to understand this in terms of what it means in terms of like resisting new technologies, but understanding like these new technologies are coming and how do we adapt them to what they're doing. So let's talk about quick, what is tokenization? So tokenization is taking the ownership of something, usually a real world asset, and moving the ownership to the blockchain. Right. So real quickly, what the blockchain is a distributed ledger technology. Right. So I'll tell you, we were talking with the team earlier today. How do we explain this in the simplest ways possible? But basically, think about this. Think about all the processes in your business that you have to go to third parties for, or you have to go to the government for, all these things. Why do we use these other parties? Because, like this task needs to get done, and they're a trusted entity to get it done. So what if we didn't need a third party and we're able to actually, because the job that needs to be done still needs to be done. But if we were able to do this in a completely trustless way, then we don't need that middleman, and it will wind up being a lot more efficient to be able to get done what needs to get done. That's what blockchain does. It's a ledger that tracks actions, that tracks tasks, that tracks things digitally, and it's on a distributed ledger. So there could be thousands of computers that will be the ones that will secure this network. So when a transaction happens, one computer processes the transaction, but then every single computer checks it. to make sure it's true. And and that basically stops anyone who tries to game the system or who tries to mess with it in any way. So when it comes to asset ownership, right, this is pretty clear, right? Because we want to come in, someone's going to come in and they're like, how do I own something? Right? Think about what's the definition of how I own something today? Usually, let's say if it comes to real estate, right? I have a title. It's in the, it's usually done through a lawyer and in the local municipality and stuff like that. It's a paper trail, right? But imagine if all that was done on a blockchain, right? You can cut out a lot more of the kind of red tape in the process and make things a lot simpler and faster and easier to do. But the point is, once that asset's then on the blockchain, you can then manage the asset much more easily. So let me open up my slide again, and I'll show you kind of how this process works. So I'm going to use an example, kind of like a real estate example here, and I'll show you where the blockchain and the tokenization side fits in here, right? So here we have a process. This is again very high level here. We create a holding company, right? SPV, which is generally an LLC, that's going to wind up holding the asset. That's what's going to hold the asset that we're doing, whether it's whether it's the house itself or whether it's a loan, whatever the asset itself is that we're giving shares out to. This is the process of how it's done, right? And this is how it's done today, right? And then what's happened is the investors, they essentially what they're doing is they're buying shares in that company. They're buying shares in that LLC, in that SPV, and then their capital is generally locked up in the SPV until it's sold. Now, one of the challenges that they can have, if you want to talk about liquidity, right, is that they don't really have access to those funds until it's sold and kind of that the LLC is liquidated and they're given their funds over here. And again, this is generally where the process goes today, and where tokenization fits in is as follows. So we still do the first two steps of this process, where we create the holding company, and then you have the SPV, and then what is going to happen is you're going to have your PPM. So your PPM obviously is what you're using to basically describe your deal, right? This is where the process kind of in the real world ends, where we start the tokenization process. So what we do is we digitize the PPM. Right? We do an addendum to the PPM that allows a legal framework that allows the equity of the ownership to be moved digitally to tokens. And then what we do with the blockchain and the smart contract is that we mint the tokens, and those tokens are equal to whatever the equity shares are that were decided in the PPM. By the way, it doesn't have to be the whole asset. It could be 10% of an asset, right? Just part of that asset can be tokenized, right? You can keep the rest of it as equity or debt or whatever else you want to keep it as, and then, but part of it can be tokenized. You can get the benefits of it that way. And then what you do, and this is the really cool part, is you take all of the requirements that are in your PPM, all the legal, how shares are distributed, what the distribution schedule looks like, all that stuff, and that gets digitized on a smart contract, right? And the smart contract is essentially what is the logic that this legal document is telling us how things are going to be done, and it's put into into a basic computer code that's executed on the blockchain, and then every single step is managed on the blockchain and executed on the blockchain in a completely transparent and trustless way, right? It's done and it's safe and it's secure. And then what happens is that the people themselves who are given and distributed and given those tokens, they can take those tokens, they can hold them, and generally there's a 1 year lockup period, so they can't do anything for 1 year. But after 1 year, they can take those tokens to an exchange and they can sell them and they can trade them, and they're liquid in a real estate deal, which is kind of like the really big idea with a lot of the stuff. In addition to in terms of actually the technical details of how the whole thing actually works. Now, some of the benefits for the actual asset ownership itself, or the management of the asset itself, is that when the time comes around, you have books and records, you have accounting processes, you have compliance that needs to happen on the way. All of that can also be automated on the blockchain. All the accounting can be done on the blockchain. So imagine taking whatever process you're trying to do in today with your accounting department, with your compliance department, and turning that all into computer code. So not only will it save a lot of money, it also saves a lot of time and is a lot more accurate because you're having a computer do it, right? Because you're taking all these processes and you're digitizing them in terms of the distributions and in terms of the accounting and compliance for how the asset is managed. Okay, so I'm not supposed to say this, but I'm going to say it anyways. Basically we're going to be working on some numbers that actually going to be showing this, but basically the actual cost reduction for the asset can be between 30 to 50% over the lifetime of the asset in terms of savings. So just think about that in terms of managing an asset. These are costs, these are operating costs that instead of being put, into managing the asset, can be allocated to other parts of the business for growth and for other things that aren't needed for growing the assets. Now, one thing that's important also keep in mind, it's a little bit of a misnomer that like people think sometimes that tokens are an easy way to raise capital. So I'll tell you right off the bat, don't think that. It's not true. Okay. Here's the important thing to understand about tokenization. It is a tool. Okay. If the underlying asset, the underlying deal is bad, or no tokenization or anything on blockchain is going to help solve that problem, right? But if the fundamentals are good and you have a good deal, all this does is give you additional flexibility, additional optionality, and allow you to be able to get more control of the asset in terms of where it can be distributed. It's fractionalization, being able to take up different parts of it and kind of divide it up as needed, as well as being able to get those cost savings by automating some or even or all of the accounting, compliance, and books and records. So just a real quick kind of like, I want to talk about compliance, because this is actually a really important point. This is something that I think really kind of sets Solid Block apart, is a really heavy focus on compliance, doing everything within SEC regulations. Many of our competitors in the industry, some of them will play a little bit of games in terms of how they position their tokens. So I want to say straight out, these legally are security tokens. Some people say they're utility tokens, or they'll say they're crypto tokens. Now, just real quick, crypto, there was a bill that went through the first kind of showing in the House last week, which actually does not impact security tokens at all, because security tokens are already regulated by the SEC according to the SEC rules, right? So I'll just explain kind of the difference real quick. So you have your crypto assets, your Bitcoin, your Ethereum, all these crypto assets. Again, the entire thing is in price discovery. Again, right now it's down. It's going to go back up again because the whole market's trying to figure out how we price these digital tokens. What we're doing, and what really drives the value of the tokens on our side, is these are security tokens that are driven by the value of the asset, by the same NAV you would use to value an asset without the tokens. All it is whatever the NAV is divided by the number of tokens, that's the value of the token. So that's kind of the difference between where this sits. We're using blockchain as a technology, and it's used for both of these things. But in one side, you're using blockchain technology as to create an asset, digital asset out of thin air, right? And one, we're using blockchain technology as the rails for something that's already existing in the real world. That's kind of what the difference is. And everything's working within SEC rules. And it's also, I'll give you a good framework to kind of listen to and understand what the general discussions are. If you hear things about regulation, right, we're still very early. So imagine you went back 100 years, 120 years, and steel had just been invented. And you went to a politician and you said to a politician or a regulator, and you say, hey, do you think it's a good idea for us to build a 100-story tall building with this new material that has never been proven at this point? Now, the engineers would say, of course you could do it, because on an engineering level, it completely checks out. But anyone in a political or regulatory framework, well, their obvious answer is going to be no. Right? Of course you can't do that because it hasn't been proven yet. So we're just like that kind of right now in the blockchain space. When you understand the fundamentals of it, right, it's obvious what can be done here. But from the regulatory standpoint, there needs to be a lot more feelings of comfort before people are going to start feeling comfortable with it. And this is also really going to help kind of the adoption of that mainstream. And I think right now, the fact that, for example, there is a crypto bill is a very positive step, because in terms of kind of getting clarity around some clarity of regulations. I do want to talk about the risks. So what are the risks of tokenization? So let me give you a risk, right? So this is something I've heard. So what happens if I do this? What happens if I take my asset, I keep my, you have to tokenize the whole asset. Actually, know that there's one of our competitors that will actually trick you into tokenizing your whole asset so that you'll pay more money. So you don't have to do that. Right? You can tokenize whatever percentage you want. You have complete control. And what you can do is, you tokenize it, and then you go to your LPs and say, hey, we have these tokens for you, right? We're doing this new innovative thing. We want to do tokens. And they're like, well, I don't want to do tokens. I want to do it the way that I did it in the past, right? So what do? Are you stuck with these tokens now? It's like, no, it's not the case at all. So one of the things that you say in that addendum of the PPM, the equity is transferred to the tokens, but it can also go right back to the shares. So basically, there's no risk in actually tokenizing or doing any kind of issue or having any issues whatsoever, with the kind of what you're doing with the equity of the building, because the LP can decide. The LP can decide if they want to take those tokens, or they can decide if it's done with shares. You can take those tokens, you can convert it back to shares. Very simple, very easy to do. So again, what these tokens are, they're representatives of shares. So the person can decide, do I want to take hold of these tokens, or do I want to, kind of do things the old-fashioned or traditional way? So just to recap kind of what we covered here, kind of talking about understanding blockchain, where it's going and how it's going to really be changing and revolutionizing everything in the very, very near future. The mindset for change, how to understand technology changes as technology continues to evolve, right? It requires different ways of thinking. And by looking at different stories and patterns throughout history, you can kind of start to see where this is going to be going in the near future. Even in days like today, where things are down, right? Things recover, right? And by the way, it's not just crypto; everything's down right now. That's the topic for a different webinar. And then we talked about how tokenization and smart contracts, how they work, and how they help make tokenized assets cheaper than managing traditional securities by automating a lot of the functions of actually managing those assets, as well as all the other benefits that you get with that. So with that, I conclude. Does anybody have any questions? Feel free to drop in the chat. I believe there's also a Q&A section here on the Zoom webinar, so feel free to drop any of your questions on either of those two chat areas. All right, Wayne, you said right. Sam Walton opened his first Walmart that was age 44. All right, so Eric asks, how do you distribute revenue profits to token holders? That can be done. So I'll tell you the easiest way to do it okay. So I'll explain the process. It's really funny. Someone asked this question before the webinar, and I meant to do a slide for it, and I didn't get to it, and I apologize for this. So if you distribute revenue to tokens, you don't actually distribute more tokens. What you can do is you can, I'm assuming you're talking about, say, like rental income. What you can do is you drop USDC into their wallet, right? Which is basically it's a stable coin pegged 1-to-1 to the US dollar, right? This is where ideally everything's kept in crypto. And then also there are options where it's being developed right now, so it's not finalized yet, but there will be options also in the future to be able to actually just do distributions from bank accounts. Okay, hold on, where are we here? What is the cost associated to tokenize any real estate? Yeah, so the cost generally is, so it depends on a few factors. Generally depends on the kind of complexity of the deal, but for, I can tell you straight off, the general expectation, depending on a number of factors, can be between $25,000 and $50,000, give or take. Could even be lower, depending on your deal. So you're Mr. Anonymous Attendee. I'm not sure who you are, but what you could do, I would invite you, anyone else, by the way, who's on here who wants, you can head over to solidblock.co. In the upper right-hand corner of the screen, there's a big purple button that says tokenize. And what you can do is you can actually give us your information of your property, of your deal that you're thinking about tokenizing. And then we'll schedule a call with one of our account managers to talk you through it and see what's the best way to be able to tokenize your asset. Okay, cool. Anyone else have any other questions? All right, guys, this is always fun. Oh, wait, another fast. Here we go. What is the cost to hold an asset as gas fee? What is the holding fee? What is it? What does it? How does the token minting process work? Okay. All right. Great questions. The cost to hold an asset. I'm assuming you're asking about like what the gas fees are for this. So I'll give you two answers for that. The first one is to hold it, you actually don't pay gas fees. Gas fees are only with the transfer of it. Right? Once things are held, if you're holding your wallet, there's nothing, nothing's happening, right? Basically, what gas fees are, they're essentially the service fees to the miners that are the miner that is running the network that's actually processing your transaction. Right, so that's what the payment is. And the main blockchain that we work on and right now is kind of the industry standard. Another time I can give my kind of opinions on blockchain. I don't think it's going to be the standard for forever. I think other ones will dominate it. But basically, it's run on a way that basically requires a lot of electricity for people to be able to process these transactions. And by doing that, they charge more money to process those transactions. Something like Bitcoin, for example. So this is, I'll give you a little blockchain primer here. So Bitcoin is run on proof of work, and so is Ethereum. It's called proof of work, which is basically, I have the way that basically how powerful my machine is, allows me to be the person who would be most likely to get the transaction, because when I get the transaction, I want that transaction because I get the reward for processing that transaction. That's what the gas fee is. So there's other technologies that are coming up, called proof of stake, which doesn't require electronic. This is also why you have kind of like this FUD that people talk about in terms of energy consumption and stuff like that. Now, Bitcoin doesn't have the same problem as Ethereum, because Bitcoin, you're only doing one thing. It's a straight ledger. You're literally just saying, okay, this money goes here, this money goes there. It's one action. When you're adding smart contracts and kind of applications to it, kind of what we're doing here, and there's multiple things that has to be done, there's a lot more load on the system required, and that's why you have a much higher fee. Once proof of stake becomes more mainstream, and you have companies like Solana and Cardano, I personally think Cardano will become the number one in the next and pass Ethereum. Ethereum is actually trying to move over to proof of stake right now. It concerns me a little bit, whereas Cardano is doing everything I think right in terms of their building from the ground up. In terms of building for the long term, everything's great today, but like in terms of the real issue is scalability. That's really the problem. So that's why they're trying to transition to doing this. They answer the rest of your, okay, fine. Holding fee, no holding fee. How does the token minting process work? We mint the tokens. It's not that's anyone can mint a token, right? We mint the token, and then with the real challenge really is the smart contract in terms of defining how that token is used, right? Because you can also, it's not just by the way the ownership of it. So one of the things you can do is you can define, and it's actually back to our compliance point. I'll add this because I think it's actually an important point. Is that one of the benefits of tokens is the ability for there to be a secondary market for real estate, right? So somebody buys it and then they want to sell it. There's create this whole secondary market of different projects. And how do you stay compliant if someone needs to be an accredited investor? So what you can do is not what you can do. What is baked into the smart contract is that the token can only be sent to whitelisted wallets. So whitelisted wallets mean that the person has gone through KYC AML either on the solid block system, and we also have relationships with a few exchanges, T0 and INX, and the wallets that are whitelisted on their platforms, right? So you would send it to one of these wallets, one of these exchanges, and then the smart contract will only allow you to be able to transfer it to a whitelisted wallet. Right? So that's also from the compliance part, kind of how we are able to stay compliant with everything afterwards. All right, okay, questions just came in. What blockchain do we use? Carlos asked that. The blockchain that we use is Ethereum. It's Ethereum, and some of the stuff is on Polygon. We're looking at Polygon as well for its speed and for its lower costs. As a property owner, what is the total cost of ownership of the solution on blockchain for one-time fee and a 10-year tenure? So again, one-time fee to get things started, depending on the details of your deal, is $25,000 to $50,000, and you would say over 10 years. It would depend on your asset. So you're also someone who would probably want to reach out to us. All right, cool. Anyone have any questions? Anyone else have any questions, I should say? All right, very cool. So awesome, guys, this has been great. There will be a replay. It will probably be uploaded to our YouTube channel if you want to see it yourself again. Or hold on a second. There are more questions here. No, there aren't. My bad. I am missing. My bad. There are two windows here for questions. I apologize. I missed a whole bunch of your questions. Just give me a second. Do you see VC funds tokenizing? 100% I see VC funds tokenizing. 100% I see them tokenizing. Because keep in mind, it's primarily real estate that's been doing this, but any real world asset can be tokenized, right? Anything can be tokenized. Just really what you're doing is you have to have some type of a legal framework to define ownership, and then that gets moved over to the blockchain. It's very simple. So can you do a private chain for the property level information, but public chain for the transaction? Private chain for the property level. information. I'm trying to understand what you're asking me here. Can you do a private chain for the property level, but public chain? I mean, the public chain is the transaction is public, so that I can tell you for sure. I'm assuming when you're asking property level information, you're saying like the details of the property, like what the property is worth, stuff like that. So that is gated. That's not publicly available. What you can see on the blockchain is these tokens move from confidential. Yeah, so the answer is yes, that is gated. So I'll kind of explain a little bit kind of how that works. So what's public, is this wallet has this number of tokens and it was transferred to this wallet with these number of tokens. So that's public. But information on the property itself, that's gated, right? That's generally done through the like the smart contract the details of the code are not visible, only the executions of them, right? So again, ownership can move back and forth, but the actual details of the deal, again, once again, gated behind a login. All right, very cool, guys. So this was great. We're probably gonna do more of these. I'm starting to enjoy these things next time. And again, watch out for the this webinar to be posted up on YouTube. And I look forward to seeing all of you guys on the next one. All right, talk to you later. See you, everyone.